Let's start discussion on very important topic, that is a regulatory landscape of Basel III and the FRTB, Fundamental Review of Trading Book related. So we discuss all these details in this video. So before start with video, I'll request you, I'll completely produce the video series for the market risk quant analysts role. So if you are interested in the quantitative analyst role, so please like and subscribe my channel. So it is and the third video for that. So thank you so much guys once again to join my course. So let's start discussion on this video. So we will first discuss on the Basel III framework, so, and its key objective and the key performance of the Basel III frameworks and how it will work. So, let's start discussing on the overview of the Basel III framework by step by step. So, it is an the regulatory framework proposed, and it is an we use for the capital and liquidity standard and the systematic risk reduction and the global regulatory impact we use for the Basel III framework. So, Basel III is an international agreed set of regulatory measures developed by the Basel Committee on Banking Supervision, which we also called as BCBS. Okay, in response to the global financial crisis of 2007 and 2008. Uh, and it is and the primary aims to strengthen the regulatory supervision and risk management of banks. So the aim of to introduce the Basel III committee is to strengthen the regulations, supervisions, and the risk management of the bank, like market risks, credit risks, operation risks, or liquidity risks. The framework introduced more stringent capital requirement, enhance the liquidity standard, and improve the overall resilience of the banking sector. And the Basel III built upon the previous accord of Basel I and the Basel II. So while creating the Basel through, they are working on the pain points or the shortcomings, or addressing the shortcomings, and incorporated lesson learned from the crisis of 2008 and 2007. So accordingly they built the Basel 3, and it apply to internationally active banks and set a minimum standard that the national regulator can adopt, and the enhance the performance and design to ensure the bank maintain the sufficient capital and buffer the absorb losses during the period of financial stress or the financial crisis, their reduction in the systematic risks and promoting the financial stability. And key component include the liquidity coverage ratio, in that the Basel III we add, and the net stable funding ratio NSFR, and revise the capital adequacy requirement. These measures collectively aim to improve the quality and the quantity of capital held by the bank, and enhance the transparency and reduce the likelihood of the future financial crisis. So that's the overview of the Basel III. Let's discuss on the key objective and the key performance of the Basel III. So it is under capital quality and requirement, capital buffer, liquidity standard, and the market revision. So the primary objective of Basel III are to improve the quality and quantity of capital held by the bank, and enhance the risk management practice, increase the transparency, and reduce the systematic risks. To achieve these goals, Basel III are introduced the several key reform practice in raise the capital minimum capital requirement, and including the common equity tier 1 CET ratio of 4.5%, and the total capital ratio of 10.5%. So second, it introduced the capital buffer such as the capital conservation buffer and the counter cyclic buffer, which include the design to build up during the period of economic growth and draw down the during the downturn. So, third Basel committees implement the liquidity standard through the LCR and NSFR, ensure that the minimum maintain advocate and meet the short and long term objectives, and additional that liquidity standard through the LCR and NSA for ensuring during the maintain advocate and liquidity to meet the short and long term objectives. With that active the reform the collective aim to create more resilience and banking capi- capable of withstanding financial shocks and supporting the real time economic cycle, and that will improve the performance of banking and to manage the banking rules and regulations. That's the objective of Basel III. So let's discuss on the topic of market risks and the FRTB. So what is and the market risks, and what are the components and what are the approaches we need to take for the FRTB. So let's discuss on the introduction to the FRTB. So FRTB stand for the fundamental review of the trading book. So it is an the comprehensive regulatory framework developed by the Basel Committee on Banking Supervision to overview the market risk capital requirement for the banks. It was introduced as a part of Basel III reform in the response to the deficiency observed during the 2008 financial crisis, and FRTB aimed to enhance the resilience of the banking system by ensuring that banks hold sufficient capital to cover the potential losses from trading activity. Of one of the key motivation behind the FRTP to address that the inconsistent treatment of market risk exposure, and that lacks the clear boundaries between the trading book and the banking book. So they are creating what are the trading book activities and what are the banking book activity which is previously allowed to for the regulatory arbitrage. And FRTB introduced more stringent a definition that these boundaries and mandate higher the quality and quantity of capital. It also replaced the value at risk matrix with the expected shortfall or years. So to better the capital tail risks and market trade scenario, by implementing FRTB, regulator seeks to create more robust and consistent approach to market risk measurement and capital advocacy across the institution. So that's why the introduction of the FRTB. Let's move on the next slide, that is a component and the approaches of FRTB. So trading and banking book boundaries, standardized and simplified approach, internal model approach, and data granularity governance. So FRTB introduced several key component and advocate for calculating the market risk requirement. Framework define the stringent boundary between the trading book and the banking book and ensure the security intent for active trading are appropriately classified and subject for FRTB calculations. For the capital component, FRTB offer three approaches. First one is a standardized approach, second one is internal model approach, IMA, and third one is a simplified standard approach, so that's we call SSA. So the standardized approach is based on the regulatory prescribed parameter and use a sensitivity based approach to assess the risk. So it is detailed and designed to directly implement, but typically result in higher capital charges. So internal model approach allow bank to use their own model subject to regulatory approve and rigorous validation, including the passing of profit and loss attributor test and back test scenario analysis. This approach is more complex but can lead to lower the capital requirement. The SSA, the simplified standard approach, is an intent for the smaller bank with limited trading activity and offer a simplified version of the standardized approach. FRTB also emphasizes data granularity and governance requirement, requiring banks to upgrade their IT infrastructure and the management system. These components collectively aim to improve the risk sensitivity and reduce the variability in capital and outcome to enhance the transparency in market risk reporting. So that's the component and approaches for the FRTB. So let's move on the implementation and the impact of the FRTB. So we will discuss on the challenges in implementation and impact on the financial institution on that slide. So let's discuss the data granularity, one of the challenge, model validity and complexity, regulatory operational demand, and the cross department collaboration. So implementing FRTB and the Basel III is a present several challenges for the financial institution. One of the primary hurdle is high data granularity required for accurate risk assessment and capital calculation. Bank must collect the process and management vast amount of detailed data across the various asset classes and trading desks. These necessity significant upgrade the IT infrastructure, risk management system, and additionally the complex of model validation under the internal model approach depend the robust governance framework and skill personal. Bank must conduct the rigorous testing and including the profit and loss attribution, back testing, scenario analysis, complex overview testing to gain the regulatory approval for using the internal model and then translate into the implement the interpreting new rule, assessing their impact on align with business strategies and accordingly regulatory timeline and are tight and institution must ensure the compliance and while maintaining operational efficiency. Furthermore, smaller bank may face resource constraint, making it challenges to implement the full scope of reform. Or all successful implementation require the coordinate effort across the risk, finance, compliance, and IT department, along with the proactive engagement with the regulation. So that's the challenges we face. So let's move on the next slide, that is impact on the financial institution. So it is on the last slide. So increase the capital requirement, enhance the risk sensitivity and operational complexity and compliance and the strategic impact on the trading book. So the importance of Basel III and FRTB has significant impact on the financial institution. One of the most notable impact is increase in capital requirement with which affect the banks and capital allocations and profitability. It enhances the risk sensitivity and granularity of the new framework, lead to more accurate but often higher capital charges, especially in the standardized approach. This may prompt banks to regions their trading strategies and product offering. The shift expected shortfall and the risk measure improve the capture of tail risks but require more sophisticated modeling and data management. Institutions using the internal model approach must invest the model development, validation, governance, testing, scenario analysis, which can be resource insensitive and require more time. This reform also operate the greater transparency and comparability across the banks and enable the regulator and stakeholder to better assess market risk exposure. However, this increase the complexity and compliance burden may lead some bank to scale back certain trading activity and potential affecting the market liquidity. So overall, while the reform the enhance the financial stability, they also necessitate strategic adjustment and operational enhancement with the financial institution. So that's the end of this video. Guys, if you like my efforts and video content, and if you want to see entire series of market risk analysis, so please do like and subscribe my channels. That's motivate me to create and more such videos for you. Once again, thank you so much guys for attending this entire video. So please do like and subscribe my channel. Thank you so much.